Right now, as we watch the ticker tape move, SoFi Technologies Inc. is trading at exactly $27.88, pushing up by $1.16, which translates to a robust 4.34% gain on the intraday session. When you see a move of this magnitude in the middle of a Thursday trading session, particularly one that pushes the asset near the $28 psychological resistance level, you have to look beyond the headline number and understand the mechanics driving the order flow. The volume we are seeing today is not just retail enthusiasm, it suggests a coordinated accumulation by institutional capital that has likely been waiting for a confirmation signal above the $27 mark. Most investors looking at this screen see a digital bank having a good day, perhaps riding a wave of broader sector optimism or a specific analyst upgrade. That is the expectation, that SoFi is simply a high-beta banking play moving in sympathy with the wider financial sector or reacting to a slight dip in treasury yields. The reality, however, is far more nuanced and aggressive. What we are likely witnessing is a structural repricing of the company's risk profile, moving away from the valuation of a traditional lender and toward the valuation multiples typically awarded to enterprise technology software firms. The market has spent years treating SoFi like a slightly more digital version of a regional bank, punishing it whenever credit spreads widened or loan originations slowed. But the price action today at $27.88 signals that the tech platform narrative, the side of the business driven by Galileo and Technisys, is finally forcing the hands of the bears. This is not just about selling loans. It is about the market waking up to the fact that SoFi is becoming the backbone for other fintechs, effectively selling the shovels during a gold rush. That realization creates a violent upward adjustment in price because the models used by Wall Street analysts have to be updated to account for higher margin, recurring technology revenue rather than just interest rate-sensitive lending income. As we watch the chart, notice how the stock behaves every time it dips a few cents. It is immediately bought up, creating higher lows on the 1- and 5-minute candles. This stair-step pattern is a classic signature of algorithmic buying programs that are instructed to fill positions without spiking the price too drastically. Yet the supply of shares is so thin that the price is drifting higher regardless. When you compare this intraday volatility to something like Tesla stock, you usually see wild swings in both directions, but SoFi today is demonstrating a controlled, grinding ascent, which is often more bullish because it implies a lack of heavy selling pressure at these levels. The bears who were shorting this stock in the low 20s have likely already capitulated, and what we are seeing now is fresh capital entering the trade looking for a breakout toward $30. This brings us to the broader context of where capital is flowing in the current market environment. Retail investors are often paralyzed by the sheer number of options available to them. You have people debating whether to put their money into Schwab Intelligent Portfolios for a hands-off approach or to engage in active trading via platforms like Interactive Brokers. In this chaotic landscape, SoFi has managed to capture a very specific demographic, the high earners who are not quite rich enough for a private wealth manager at a major wirehouse, but are too sophisticated for the gamified interface of a basic trading app. This positioning is critical because it drives the flywheel effect that you hear about in earnings calls. When a user joins for a checking account, they are cross-sold into SoFi Invest and then eventually into a mortgage or personal loan. Today's stock movement reflects the market's growing confidence that this cross-selling strategy is actually working at scale, lowering the customer acquisition cost compared to peers who have to spend heavily to acquire a user for just a single product. When we analyze the volume shelf, there is a massive amount of transacted volume sitting between $24 and $26. That zone has now solidified as a rock-solid floor. As long as the price holds above that level, the trend remains aggressively bullish. However, we must remain objective. The RSI on the daily chart is approaching overbought territory, which usually signals that a brief consolidation or pullback could be imminent before the next leg up. Smart money typically uses those pullbacks to add to their position, whereas inexperienced traders often panic and sell. It is crucial to distinguish between a trend reversal and a healthy pause in an upward move. If you are watching the order book, pay attention to the bid sizes at 27.50. If those bids disappear, we could see a quick flush down, but if they replenish, it confirms the bullish thesis. Now, let's talk about the competitive environment because you cannot evaluate SoFi in a vacuum. The fintech space is crowded, and every player is fighting for the same wallet share. On one side, you have the legacy giants like Fidelity Investments, Fidelity Mutual Funds, and the entire Fidelity brokerage ecosystem offer a depth of research and a level of trust that is hard to replicate. They have trillions in assets and a sticky client base that uses Fidelity IRAs and Fidelity Wealth Management Services for generational planning. Then you have the disruptors like Robinhood. The Robinhood app completely overhauled the user interface expectations for the industry. Robinhood stock trading, Robinhood crypto, and Robinhood cash management appealed to a younger mobile-first generation. They even introduced Robinhood fractional shares to lower the barrier to entry. SoFi sits uniquely between these two extremes. It offers the user-friendly, mobile-first experience that rivals the Robinhood app, but it layers on the banking and lending utility that mimics a traditional bank, albeit without the physical branches. Furthermore, when you look at the platform capabilities, SoFi Invest has been aggressively rolling out features to close the gap with more sophisticated brokers. While Interactive Brokers trading platforms are known for their professional-grade tools and low margin rates, specifically focusing on Interactive Brokers' fees and the global reach of an Interactive Brokers account, SoFi has focused on simplicity combined with access. They aren't trying to be Interactive Broker stock trading for the day trader. They are trying to be the financial operating system for the young professional. This distinction is why the stock is trading at $27.88 today. The market believes that the winner-take-most dynamic in fintech will favor the company that owns the entire relationship, not just the trading account or just the savings account. The comprehensive nature of their offering, which includes everything from student loan refinancing to IPO access, creates a moat that is deeper than it appears on the surface. Let's pause for a second and get a pulse on the room. Comment below how many shares of SoFi you currently hold and what your average cost basis is. Are you green on this position, or are you still holding bags from the previous highs? I want to see where the community stands. Moving back to the analysis, we need to discuss the business model in greater detail because that is where the long-term value proposition lies. SoFi operates under a bank charter, a critical designation that they secured a few years ago. This was a massive pivot point. Before the charter, they had to rely on third-party banks to hold their deposits, which meant they had to share the economics. With the charter, they can use their own members' deposits to fund their loans. This lowers their cost of capital significantly. In a high-interest rate environment, this is a massive advantage while other fintech lenders are scrambling to find funding in the capital markets at expensive rates. SoFi just uses the money sitting in their members' checking and savings accounts, paying them a competitive yield while still keeping the spread for themselves. This spread income, or net interest income, provides a stable floor to their earnings that pure-play tech companies do not have. Moreover, the technology platform segment, comprising Galileo and Technisys, is the hidden gem. Think of Galileo as the plumbing for digital banking. When you use a debit card from a neobank or a non-financial brand that offers a card, there is a good chance Galileo is processing that transaction in the background. SoFi collects a fee every time that happens. This B2B revenue stream is incredibly attractive because it is recurring and high margin. It diversifies the company away from just credit risk. If the economy slows down and people stop taking out personal loans, the transaction volume on the tech platform might still be robust, providing a hedge against recession. This is why I mentioned earlier that the market is starting to value SoFi more like a software company. The multiple expansion we are seeing today, pushing the stock toward $28, is a direct reflection of investors gaining confidence in this diversified revenue mix. We also need to consider the macroeconomic tailwinds that could be forming. If we assume that the Federal Reserve has stabilized rates or is beginning a cutting cycle in late 2025, this is historically the sweet spot for SoFi. Lower rates typically trigger a wave of refinancing for student loans and mortgages. SoFi built its brand on student loan refinancing. While that business faced headwinds during the government payment moratoriums of the past, a normalized environment turns this back into a cash cow. Additionally, lower rates stimulate the housing market, which benefits their home loan division. The market is forward-looking. It is pricing in these